Thanks for watching Lessons in Minutes with Jaylee. Like, share, and don't forget to subscribe.
Welcome to the final question of the CSEC Principles of Accounts January 2024 response, and that is question 5, where candidates were tested on bad debts, provision for doubtful debts, which is the same thing as provision for bad debts, qualities of a bookkeeper, and accounting concepts. If you have missed questions 1 to 4, the links are in the description below. Let's get into the question. But before you start working, do remember to read your question. On January 1st, 2023, Bookkeeper Construction Limited's books showed the following balances. Allowance for doubtful debts, same thing as provisions for doubtful debts, is $2,300. Trade receivables, $64,000. The following transactions took place during the year ended 31st of December 2023. March 12 sent an invoice to Shine Roberts for goods, $2,500 less a trade discount of 20%. So this is saying that the business sold goods on credit to Shine Roberts for $2,500, but a trade discount of 20% was given. August 26 received a check for $1,700 from Shine Roberts. So we're seeing where Shine Roberts made a payment of $1,700. December 31st, Bookkeeper Construction Limited was informed that Shine Roberts had filed for bankruptcy. And once you see this, we know that Shine Roberts will not be able to clear his debt. So the decision was taken to write off the amount owing by Shine Roberts as a bad debt. December 31st, the directors of Bookkeeper Construction Limited have decided to adjust the allowance for doubtful debts account to 2% of trade receivables. Required, complete the following 3 accounts to show how these entries would appear in Bookkeeper Construction Limited's ledger for the year ended 31st of December 2023, balance and close of the accounts at year end, showing transfers to the final accounts where appropriate. Now we're going to look at the first account that we are required to prepare, and that is the account for the debtor, Shine Roberts. And we're going to get back to the question to get the details relating to Shine Roberts, this debtor. So let's take a look at that. So the first details that we have is March 12, where the goods were sold on credit to Shine Roberts, $2,500, and there's a trade discount that is given. Now, once you sell goods on credit, the double entry to record that is debit the trade receivables, and in this case, that is Shine Roberts' account, and you would credit your sales. But how much are we going to record? We have the value of the goods sold on credit of $2,500. However, there's a trade discount of 20%. So from these details, we need to determine what is the actual credit sales to Shine Roberts for March 12 based on this transaction. So first thing we'll have to do is to take out our trade discount, where the trade discount is calculated by multiplying 20% of the 2,500, and that gives us a trade discount of 500. Now the trade discount will be subtracted from the value of the goods of 2,500 to give us the amount that is due. So to calculate the amount due, it's 2,500 minus the trade discount of 500, which gives us 2,000. So the actual value of credit sales on March 12 to Shine Roberts is $2,000 because Shine was given a trade discount of $500. So let's record that in the account for Shine Roberts. And remember, in this case, the account should be debited. Let us make the entry in Shine Roberts' account. And remember, we need to debit Shine Roberts account with that credit sales. So it is our date 2023, that's March 12, and the details is the other account affected. We're in Shine Roberts account. The other account affected is sales. Remember, we're doing double entry, and the amount that is due is $2,000. Let's get back to the question. And do remember, we're just focusing on Shine Roberts account. Remember, if you sell goods on credit, the sales account is credited while the trade receivables account is debited. Back to the question. Looking at details relating to Shine Roberts, because that's the account that we're focusing on. Now, August 26th, we're seeing that Shine Roberts made a payment. The debtor is paid. When your debtor pay, which is your trade receivables, make a payment, it actually reduces the amount that is owing by the debtor, that trade receivable. Trade receivable is an asset. And if there's a reduction in asset, you are to credit that trade receivables account. So Shine Roberts account should be credited. Apart from that, we receive a check. Once the business receive a check, we know that bank is affected. Yes, we're doing simple double entry right here. And once the bank is affected, we now need to determine whether there is an increase or decrease. Bank is an asset. The debtor is paying us, paying the business. So it therefore means that there's an increase in the bank account. Once your asset increases, you are to debit. So the double entry for this is that Shine Roberts account should be credited because there's a reduction in the asset of trade receivables, and the bank account should be debited. But remember, we're focusing only on Shine Roberts account. Hence, our entry in the account is on the credit side, August 26th. That's when the transaction took place. Or details of the item affected, which is bank, and the amount that was received by the business paid by that trade receivables is $1,700. So we're seeing that Shine Roberts account decreases by $1,700. Let's get back to the question to pick up the other details or the transaction relating to Shine Roberts, that trade receivable. And that is December 31st, Shine Roberts became bankrupt. And that debtor, the trade receivable, filed for bankruptcy. The business now decided, which is Bookkeeper Construction Limited, decided to write this off as bad debt. Now, when you're writing off bad debt, that's an increase in the expense of bad debt. So it therefore means that that account should be debited because there's an increase in the expense. And once you're writing off bad debt, what you're doing, you're relieving the debtor of what they're actually owing, and the business is taking on that burden. So that is why it is an expense. So the debtor account should be credited. Now, how much are we going to record as the bad debt? We have to go back to the account to see what is happening there. Apart from that, we could simply look at the first transaction where the amount that was due was $2,000. The debtor, the trade receivable, made a payment of $1,700. So it actually means that what is owing, what is left to be collected from the debtor is $300. However, the debtor is unable to pay because the debtor is bankrupt, and so writing that off as bad debt. Going to the account of Shine Roberts, apart from using the transactions from the question, you could simply look at the account, attempt to balance it off. The difference in what you're seeing in the account is what you'll write off as the bad debt. So on the debit side, we're seeing $2,000. On the credit, we're seeing $1,700. It means that the debtor, Shine Roberts, was owing the business $300. Now the business is unable to collect that, so they're writing that off as bad debt. When you're writing off bad debt, remember, your bad debt account is debited because that is an increase in expense, and the trade receivables account is credited. So on the credit side, we're going to record December 31st or details other item affected. And yes, that is bad debts. And the amount we're writing off as bad debts is $300. So where now at the end of the period, we can simply close off the account. Total on the left is 2,000. Total on the right, when you add up 1,700 and 300, that gives you 2,000. So once you write off what the debtor is owing as bad debt, there's not going to be any balance in the trade receivables account. All right, so that is the account for the trade receivable Shine Roberts. And moving into the next item that is required of us to complete, and that is to prepare the bad debts expense account. Now, what details are we going to use to prepare the bad debt expense account? Remember, bad debt is an expense, increase on the debit and decrease on the credit. Now, if you go back to the account for Shine Roberts, you will be able to pick up the details as it relates to bad debt. Now, what are we going to do? We're going to complete the double entry in the bad debt account. Now, from Shine Roberts account, which is a trade receivable, the business, which is Bookkeeper, has written off $300 as bad debt. That is what we are going to record in the bad debt expense account. Let's make the entry in the bad debt expense account. So we are going to be debiting the bad debt expense, and that is 2023, December 31st, or details is the other item affected. In this case, we're going to record the name of the debtor, the trade receivables that we write off as bad debt. In this case, it is Shine Roberts, and the amount written off as bad debt expense is $300. There is no other entry based on the question. So at the end of the period, remember, we were asked to close out the accounts or balance off the accounts. In this case, we're going to be doing the closing entry for the bad debt expense account. When you're doing closing entries for expense, the account to be debited is the income statement, or you can use profit and loss account, and the expense account is credited. So in this case, we're only focusing on the expense account. So it therefore means that we're going to make a credit entry to close out the account. All this is saying is that the amount from the expense account is transferred to the income statement or the profit and loss account to prepare the financial statement. So again, the expense account should be credited. We're doing the closing entry, so our date is 2023, the end of the accounting period, which is December 31st. Our details, because it is an expense, we're transferring this amount from this expense account to the income statement, and that is $300. And that will complete the bad debt expense account. We're now moving on to the other account that we should prepare, and that is the allowance for doubtful debts account. Yes, the provision for doubtful debts account. So we're going back to the question to gather the details relating to the allowance for doubtful debts account so we can prepare the account. Now, if you recall from the question, there is an opening balance in the allowance for doubtful debts account, and that is 2,300. This is what we're going to record in the account first. And do remember that the allowance for doubtful debts account carries a credit balance. So the opening balance should be credited to the allowance for doubtful debts account. So the first entry there is at the beginning of the period 2023, January 1st, details balance brought down, and that is 2,300. Remember, the account carries a credit balance. That is where the balance brought down should be recorded. In fact, when you're preparing the allowance for doubtful debts, your first entry must be credited. Now, let's get back to the question to gather additional details relating to the allowance for doubtful debts for the period. Now, in addition to the opening balance On December 31st, we were told that the directors of Bookkeeper Construction Limited have decided to adjust the allowance for doubtful debts to 2% of trade receivables. Now, what do we do with this information? We're going to pick up the trade receivables value of $64,000, and we're going to multiply that by the rate, the allowance for doubtful debts rate of 2% to determine the balance for the allowance for doubtful debts for the end of the period for 2023. And let's get to the account and prepare some workings for that. So remember, we have to do our workings, and we pick up the debtors balance, which is a trade receivables balance, and multiply that by the rate of 2%. So it is 64,000 multiplied by 2%, and that gives us 1,280. Remember, the 64,000 is a balance that is in the trade receivables account. And we multiply this by the rate of 2%, and this gives us a balance in the allowance for doubtful debts of 1,280. Now, what do we do with this? We're going to compare that with our opening balance of 2,300 to determine what is the change in the allowance for doubtful debts for the period. Now, if you look at the previous value, it is 2,300, and now we're seeing a reduction in the balance of the allowance for doubtful debts, which is where the balance is now at 1,280. So there is a reduction. How much is the reduction? The reduction is actually a revenue, and the amount it decreases by is the 2,300, which is the previous balance, minus the current balance of 1,280, and that gives us a value of $1,020. Now, once your allowance for doubtful debts, your provision for doubtful debts, your provision for bad debt decreases, it is a revenue. Remember that. And the amount it decreases by is what we're going to send to the financial statement, the income statement. And this is $1,020. The double entry to record the reduction in the provision for doubtful debts is that you debit the allowance for doubtful debts account. Debiting the account, you're actually reducing the balance. And the income statement is credited. So the allowance for doubtful debts account should be debited, while the income statement is credited. So we're going to carry out that action in the account by debiting the allowance for doubtful debts with that 1,020. So that's December 31st income statement, and only the amount it decreases by we're entering. Now, once you enter that, the next thing that you're going to do is that you're going to balance off the account. And in balancing off the account, remember, we find the difference between the two sides, and the side that is short is our debit side. How much is it short of? The difference is 1,280, and that 1,280, if you notice, that is the balance that we would have generated earlier when we did our calculation. And our details, there is balance carried down, the amount is 1,280. Now, once you record that, the next step is to enter your totals. And our totals are 2,300 on the left and 2,300 on the credit. And our final action that we're going to carry out, once you have balance carried on, you have to complete the balancing off process by entering your balance brought down. In this case, your balance brought down must always equal to the balance in which you calculated in the first step, which is, in this case, it is 1,280. So January 1st, 2024, balance brought down 1,280. And that takes care of part A of the question. Let's now move into the other part of the question, where we're to identify 3 qualities you would expect of a person applying to be a bookkeeper at Bookkeeper Construction Limited. Now remember, A bookkeeper duty and responsibilities include preparing accounts, balancing accounts, preparing trial balance, verifying records, etc. So in this case, we expect that the bookkeeper must have qualities such as integrity, honesty, reliability, because you must be able to rely on these people to ensure that the records are kept, they're up to date. There should be confidentiality. We don't expect that this person will be taking the business details in terms of his finances and disclose it to others. Accuracy. There must be accuracy because you want to ensure that all the records that they are entering is correct. Another is that they should possess the quality of thoroughness, and there must be attention to detail. So these are some qualities that we expect of a bookkeeper. So if you are applying for a bookkeeper's job, and these are the qualities that your employer will be looking out for. And another one there to add to the list is that the bookkeeper must be keeping up to date. So those are some qualities of a bookkeeper. Let's move into the other section of the question, and that is part C, which is the final part of the question. The following policy statements were implemented by the management of Bookkeeper Construction Limited. Each statement is identified by a unique letter code. Letter codes are in the left column, and in the right column we have the statements. The first one states, Bookkeeper Construction Limited has sold goods to Shine Roberts on credit. Shine Roberts has informed Bookkeeper Construction Limited that he has filed for bankruptcy. Bookkeeper Construction Limited wrote off the balance due. B. Bookkeeper Construction Limited purchased an office building for $340,000. The market value of the building is $400,000. The accountant recorded the purchase price of the building as $340,000 in the company's books. C. Mr. Alls, the owner of Bookkeeper Construction Limited, owns 3 different types of businesses. The transactions of the 3 businesses are separately maintained. Now you're required to complete the following table by writing the correct letter code which matches the accounting concept that corresponds to each policy statement implemented. And the first one is business entity. Which of these statements relate to business entity? And remember, business entity is where you record the details relating to the business itself in the business's record. So it is C that is the correct letter code for the first one, which is business entity. The other is historical cost. And if you go back, you'll realize that B is the statement that relates to the accounting concept of historical costs, where the records were recorded at the purchase price. And the final one is prudence concept, and that is A, where the debtor became bankrupt and the business record that. Write it off as bad debt because you want to show a true and fair view of the business, and that is the prudence concept. And that takes us to the end of the January 2024 paper.
Like, share, and don't forget to subscribe.